Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Think getting caught with your hand in the cookie jar is bad? Just wait till the IRS gets a hold of your 401k plan.
Welcome to the only show in the country dedicated to helping savers worry less about money, the WorryFree Retirement, with your host, nationally recognized retirement specialist and four-time author, Tony Walker.
Ever been caught with your hand in the cookie jar? Well, assuming you grew up in the 60s, you probably did, because back then, every kitchen had as its most prized possession a cookie jar. The purpose of the cookie jar? Well, it was a way for loving parents to reward their loving children for good behavior or doing chores. Take out the trash, your parents allowed you to reach into the cookie jar and grab a cookie. Clean your plate during supper. Yep, you got to reach into the cookie jar and help yourself to a cookie. All was well with parents and child until said child reached into the cookie jar to help themselves to a cookie without the parent's permission. Sneak a cookie and get away with it? Good for you. But get caught by your parents with your hand in the cookie jar without their permission, and you were in deep doo-doo. So what does a snotty-nosed, not-so-innocent kid getting caught with his hand in the cookie jar have to do with you and your money? Well, let's find out. Well, welcome, folks, to the WorryFree Retirement. And yes, I am that little man in the sweater vest, financial cookie jar specialist and fiduciary, Tony Walker. And today we're going to show you how to keep the government from taking more of your financial cookies and how you and your family can instead enjoy what you've worked so hard to save. But first, there's three folks here in the Louisville studios baking up a great show today. First of all, we've got America's favorite financial sidekick, Mr. Aaron Orander. Next, a young man who has a huge sweet tooth, and that's one that can't be beat, Louisville, Kentucky's most laid-back graphics artist, Mr. Derek Hudson. And finally, last but not least, our associate producer who's keeping an eye on the timer to make sure we don't overcook the show today, Miss Meek and Mild Mary Beth Combs. Okay, what do the government diving into your financial cookie jar, otherwise known as your 401k plan, has to do with this show today? Well, it's called taxes, and nowhere else do savers get surprised by the government robbing your cookie jar as much as when savers hit this magical age of age 72, something the government calls the RMD, or your required minimum distribution. Or, shall I say, that age when the government, without your permission, is going to reach into your 401k and grab their fair share of cookies. So what can you do to protect more of your cookies? Well, regardless of whether you have not reached the age of 72, maybe you're getting ready to turn age 72, or maybe you're well past the age of 72, but afraid of what will happen to those cookies when you're dead and gone? Well, stay tuned as I show you how to protect more of your financial cookies from the biggest cookie monster of them all, Uncle Sam. I'm Tony Walker. You stay tuned, and I'll be right back. Have you recently retired, been laid off, or offered a pension buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today. Welcome back to the WorryFree Retirement, and our theme today has been this thing called the Required Minimum Distribution, or RMD, which is that age and time when our politicians in Washington brought into law this idea that you have to start taking money out of that tax-infested IRA or 401k plan. Oh, incidentally, The RMD age, a lot of people don't know this, it used to be age 70 and a half. That's when you had to start taking your required minimum distribution. And as of late, that has been changed to age 72. So I thought I wanted to make a note of that. All right, speaking of RMD, our Tony in the Trenches question comes to us via a recent encounter my wife and I had with a store clerk while shopping in Louisville. As we were checking out, the clerk requested my email address for the order I was making. And when I stated Tony@TonyWalkerFinancial.com, she quickly stopped typing and looked up from the cash register's keyboard and asked, "Hey, aren't you that money guy on TV?" Her next comment went something like this. "Recently, me and my husband, who just turned 72, went to meet with our stockbroker the other day to discuss something called our RMD, something we had never heard of, and found out we were going to have to start paying a bunch in taxes. How do we keep from now having to pay all of these taxes on our money?" Well, since I didn't want to get into a planning session right then and there, I kind of just shrugged my shoulders and said something like, "Yeah, at some point the government is going to reach into your cookie jar for their fair share." What I really wanted to say to this nice lady is this: that's why you should have had a retirement specialist such as Tony Walker Financial handling your money instead of a stockbroker. You see, folks, a retirement specialist job is not just to invest your money like a stockbroker. We can do that. But it's also to make sure you have a plan for how best to use, enjoy, and protect more of it. A plan that, yes, even includes how to deal with that darn tax tumor buried inside your IRA or 401k. A plan that is there to try to keep Uncle Sam's hand out of your cookie jar, or at least limit the number of cookies he's able to grab. So how much is this RMD, and what percent of your 401k will the government reach for when you turn age 72? How do they even calculate the amount of the RMD and the taxes you're going to owe? Well, let's take a look. So basically what I did, I had our own Leanne Tinsley, we'll be talking to her in just a second, who's tax certified and located in our Bowling Green, Kentucky office. And in this example, we imagine someone was age 72 and they had $500,000 in their 401k plan. Now again, this could be a 401k plan, this could be an IRA, it could be a number of plans, but they have to be what's called pre-tax and qualified. A Roth IRA, which we'll talk about this in the next segment, the good thing about a Roth IRA, you do not have to take these required minimum distributions out, and you're going to find out why. Because they've already got their taxes. Folks, this is so the government can get their tax money from that tax-infested 401k. They're not going to let you just defer it forever. So let's take a look at the calculation. Notice everything comes across with life expectancy. The entire financial world is trying to predict when people are going to die. It's huge when we're doing retirement planning because it always revolves around death, yes, even the RMD calculation. So in this case, that's the number of years you're supposed to live at that age. And what they do, it's approximately 4% that first year. They take 4% of the $500,000, and of course in that year, that means you have to take out $19,531. And you say, well, what's that number represent, Tony? Well, that number has to go on your tax return. So again, if you're in a 22% bracket, and depending on the state you live in, they may take as much as 22 to 30% of that. Let's say it's 30%, that means $6,000 in taxes is going to have to be paid on that. And you might say, well, hey, Tony, can't I do a Roth conversion on that minimum distribution? No, they won't let you do that. So you have to pay the tax. Now we kind of fast forward down. Let's take a look at, let's see my notes here, 2030. Okay, this is working as planned because notice the balance is coming down, but as the balance of your 401k or IRA goes down, notice the distribution at 2030, now they're going to require more money. Now here's what's really kind of scary. Let's say you had this with a money manager and this thing is dropping like a rock. It doesn't matter. I mean, it's a terrible time to take money out of an account when it's going down. The government doesn't care about that. They're going to make you take that minimum distribution, which means we're taking money out of a losing account, which is a terrible strategy, which is the problem. You have no control once we get into this RMD scenario. Not good. Well, let's keep fast forwarding to one more age. Let's go down to 2037 and notice that balance is down to 351, but the RMD keeps going up. So it's a real problem, and it's one that most people don't have a handle on. And then you get into the situation where you say, well, Tony, all that's, I guess, well and good, but what happens when I die? Or what happens if I'm taking an RMD and I lose a spouse? Or what happens eventually when both of us are gone and we leave this to our kids? Do they have these same type of issues? Well, first of all, the tax tumor doesn't go away at death. It just gets passed on to someone else. But to help us go through a few of these scenarios, let's do this. We've got a live Zoom call with our own Leanne Tinsley in Bowling Green, Kentucky. So right now, let's go to Leanne. Good morning, Leanne. How are you doing this morning?
Good morning, Tony. I'm doing great. How are you guys?
We're doing good here. So, okay, Leanne, before we get started, as a full-time retirement planning firm, how many RMDs do we manage and assist our clients with in any given year?
I would say we easily touch over 1,000 accounts for our clients each year, Tony.
Yeah, and we really appreciate what you're doing. In fact, I met with somebody yesterday, Leanne, that had accounts scattered all over the place, and they were just taking their RMDs out of each account. And I told them, I said, there may be a reason we want to consolidate those, and they had never thought of that. So we appreciate that type of work that you do in helping our clients. So, all right, let's get to the subject matter at hand. I got a couple of examples. We've been talking about RMDs and what happens now when somebody passes away. So let's imagine we have a couple. The husband is 73, taking his RMD currently. His wife is 68, and all of a sudden the husband passes away. What happens to that RMD?
Well, in the year of death, he will have to go ahead and process that RMD for him. And then once the wife, she can choose to become the account owner. And at that point, the RMD rules will then apply to her.
Okay, so could she put off taking the RMDs until she turns 72?
That's correct. If she becomes the account owner, she may do that.
Okay, great. Okay, now instead of the husband passing away, let's say the wife, who is 68, she passes away first at the age of 68. Are there any changes in the amount of the RMD that the husband is currently taking or needs to change, or will it just be the same amount?
It would be the same amount. The account is in his name, so the rules still apply just to him.
Okay. One more example. This is very helpful. We really appreciate this. Okay, one more example. And now you might have to get into the weeds a little bit with some of the changes. But let's say the wife has passed away. Now the husband is 73, 74, whatever. He passes away. And let's say there's still $500,000 in this 401k or IRA or wherever it is in this qualified account. And then it's inherited by his two children. What happens under current law, or maybe what happened before, now what happens under current law with that RMD for the kids?
Well, when the Secure Act passed, everything changed for those inherited IRAs. And at this point, that $500,000 that goes to those kids has to be distributed within 10 years. Now, they're not required to take any certain amount each year, but the account has to be depleted in 10 years. So you want to be careful to not wait on that and then end up with a huge tax burden at the end of that 10-year time period.
Yeah, and it makes you wonder, doesn't it? Because our theme for the show today has been the Uncle Sam grabbing money out of those cookies out of that cookie jar. And if these taxes go up in the future, which I'm predicting they will, used to be the kids could kind of stretch out or take those minimum distributions of their lifetime. I mean, that could potentially be a windfall for the government, couldn't it? Since now they've got to take it out within 10 years.
That's absolutely right. And I'd like to say another point of confusion for those is, although RMDs are not required for Roth IRAs, once they become an inherited Roth IRA, RMDs are required on those accounts. And that does confuse people in some areas.
Very good point. Well, Leanne, we appreciate your time so much and all that you do. And we'll be talking to you soon. You make it a great day.
All right. Thanks, Tony.
You're welcome. So folks, if you're sitting there right now thinking, you know what, I don't have a strategy at all for these RMDs. I don't understand the tax ramifications. Don't know whether I should be converting those to a Roth. When I come back, we're going to talk about something called the 3 halves of life and how the 3 halves of life can help you understand RMDs, regardless of whether you're young, middle-aged, older, into the second half of life. This is going to be some good stuff. Let me get a cup of coffee. We'll be right back. We're going to get the whiteboard out. I'm Tony Walker. You stay tuned. Who can you trust? It's one of the most important decisions you'll have to make. Question is, are you ready? Well, we're here to help at Tony Walker Financial. You know, we care more about you than we do your money, and we have over 2,000 happy clients and an A+ rating with the Better Business Bureau to prove it. Rolling over a 401k, confused about Social Security, maybe you're afraid of running out of money. Learn how to use and enjoy and protect your hard-earned money. Log on now to TonyWalkerFinancial.com and let's get started. Think the law that allows Uncle Sam to reach into your cookie jar at age 72 is bad? There's another law that's even worse, one that the financial world doesn't want you to know about, called the Law of Diminishing Returns, which simply means this: the longer you hold on to and accumulate money, the less over time it is worth. Now, I know at first glance this doesn't make sense because all your life the financial world has taught you to leave the money with them because in the future, one day, you're going to need a bunch of it, which on the surface makes sense until you realize that all that time you put off enjoying the money while others have been grabbing cookies out of your cookie jar. So who are the cookie monsters out there that contribute to the law of diminishing returns? Well, let's take a look. We obviously have inflation, which is rising prices, and we'll see in a minute how we can combat that. Number two, taxes, which again, as we've talked about, the concern I have, these taxes you're putting off one day will be higher and higher, and that means not good for not spending your money. So the more you compound and grow it, the more potential taxes there will be in the future. Number three, fees. Again, the more your accounts grow, assuming someone's charging you fees on your money, the more the fees are going to grow. I hope this is making sense and why the law of diminishing returns is a real deal. Number four, low interest paid on your money. Now, folks, basically, some of you are got money over there at the bank earning 0.5%. There are things we can do on a safe basis to earn you much higher returns that you can count on, and again, that are safe. We'd be happy to talk to you more about those. And then finally, this kind of falls into my live well, die broke philosophy. Number five, you're just waiting too long to spend and enjoy this money. So to help us deal with the real world of money and not fall victim to the law of diminishing returns, let me take you on a few examples of what you need to do with something we call the 3 halves of life. Folks, I realized this years ago. What the 3 halves of life means is in the first half, you are to save money. Half-time is when you need to start enjoying it while you still can. And then finally, the second half of life, by the way, that blue represents your account balances, should actually be going down to combat the law of diminishing returns. This is the stage in life, usually past the age of 72, where you need to relax and enjoy your money. So how do you do that? Let's walk over to the whiteboard and take a look. So again, if we divide up your life into these 3 halves, the first half, again, as we've noted, is where you need to save money, and preferably on a tax-free basis. So obviously, a Roth IRA is completely tax-free when you take that money out. And assuming you're eligible and you're a younger person, let's say you're under the age of 45 or 50, if it were me, I would not be putting a bunch of money in a pre-tax account. I would want it going in after tax, so at least I know what the future taxes are going to be, which would be 0 with a Roth. Well, let's move to halftime, and that's generally the ages of 60 to 62. Now, this is an interesting time because this is the period of time when a lot of people are thinking about retiring early, or maybe they're starting to have some health issues, or maybe they want to spend more time with the grandkids. I met with a couple last night. That's where she is. She's like, I want to get out of work and enjoy my grandkids while I still can, which I can relate to that. This is the period of time where you need to make some decisions on that 401k plan. And here's your options. You can spend it, you can start giving it to your family, or depending on how much money you have in savings or other assets that aren't earning any money, you could convert that to a Roth. Again, this is things we can help you at Tony Walker Financial and help you deal with this law of diminishing returns. And then finally, as you get into the second half of life, and generally that's past the age of 72, when you get into all these minimum distributions, we're kind of at that same dilemma. Most people aren't spending as much, so that's more of a question mark. I've even got an 80-year-old client the other day that came in and said, Tony, I can't even spend this money you keep sending me. Quit sending me money. But we're trying to get it out to her because we know the taxes are going to eat her kids alive when she finally passes away. She can give it, or you can give it, and possibly you can convert it. So folks, if you're sitting there right now, regardless of your half of life, but particularly we tend to work with people who are at halftime or in the second half of life. If you're sitting there and you haven't thought about this law of diminishing returns, if you bought into the narrative that you need more and more money stockpiled at a period of time when you may not even be able to use and enjoy it, why don't we get a different game plan? That's what I would suggest. And best of all, to meet with me, the owner of the company, Tony Walker, there's absolutely no cost or obligation to do so. That's right, it's absolutely free, and you can do that in one of two ways. First, you can simply call the toll-free number on your screen, even if it's on a weekend, and we can arrange what's called a free 10-minute fiduciary phone call where I'll ask you a few questions about your situation to see if we can help you. And if it warrants, after that phone call, we'll be happy to meet with you in person at either our Bowling Green, Louisville, or Lexington, Kentucky offices. So why don't you get a game plan from an advisor who's been doing this for years? Someone who understands the mind of a saver and understands how important it is to have a written game plan so you can deal with your money so you can enjoy more of it now. Well, what does the Bible have to say about being a good steward of money and this word that's really interesting called being shrewd? Understanding how the world really works and not being so naive about the money you have. Let me get a cup of coffee again. I got to have one more cup of coffee. This is some good stuff. You stay tuned. You're watching the Worry-Free Retirement. I'll be right back. Wondering how much money you'll need to retire? Probably a lot less than you think. I'm retirement specialist Tony Walker, and for the past 36 years, I've helped thousands of savers determine when to retire and how much money they'll need in retirement, and I can help you too. To meet in person at no cost or obligation, let me invite you to log on right now to TonyWalkerFinancial.com or call the toll-free number on your screen. We look forward to talking with you soon. With the stock market at all-time highs, our nation's debt through the roof, and inflation racing out of control, now may be the best time to consider safeguarding your money. That's why I'm offering to review your 401k and other retirement accounts to be sure that you aren't taking too much risk and you're not going to run out of money. To set up your free meeting with me, simply log on to TonyWalkerFinancial.com or call the toll-free number on your screen. The late great Judge Learned Hand once said this about taxes. The law does not require one to pay more in taxes than the law requires. Problem is, most people do not understand all the complicated laws our friends in Washington create. Laws such as the Required Minimum Distribution, or RMD. Why is it that few people take the time to learn and understand how much the government can take by law, and thus will end up needlessly handing over more of their money to them? Because most people are not shrewd. Webster's defines shrewd as follows: marked by clever discerning awareness and hard-headed acumen, or one using common sense. You know who some of the least shrewd folks are? Christians. Check out what Jesus has to say in Luke chapter 16, where a worker in charge of his boss's stuff squanders the master's money. Realizing that his boss is going to be upset, instead of doing nothing, he instead acts shrewdly by quickly running to all of the boss's customers and gives them a discount if they'll pay something now. And even though the worker shortchanges his boss, the Bible says in verse 8 that the master praised the unrighteous steward because he acted shrewdly. Moral to the story? The sons of this age, meaning the real world of people who know how to deal with money and how to get more of your money in return, are more shrewd than those of us who should know better, sometimes naive Christians. So what's the point of this parable from Jesus? Well, my concern is that while us Christians are working hard to be a witness to a world of the saving grace of Jesus Christ, we can look rather foolish to the world when we blindly hand over our money to them. assuming that those we hand our money over to are looking out for our best interest when in many cases they are not. But it gets even deeper than this. Check out the next verse in verse 9 where Jesus says, "Make friends for yourselves by means of the mammon of unrighteousness," that would be money, folks, "that when it fails," can anyone say taxes? Can anyone say inflation? And can anyone say the next stock market crash? "That they may receive you into the eternal dwellings." In other words, rather than being naive about money, we Christians need to learn how the world of money and people work so that we won't look foolish to a world that in most cases is more impressed with our ability to communicate about money than sometimes they are to communicate about the things of God. Amen? And so how about you? Do you feel like the nice clerk at the store who was shocked upon discovering how many cookies Uncle Sam would take from their tax-infested 401k plan? How about another cookie monster? All those fees being deducted each year from your investments that nobody's telling you about. And what if you're lucky enough to have seen your 401k dramatically increase in value as a result of the bull market as of the date of this recording? Have you thought about how quickly those winnings will vanish if we experience another crash like we had in 2008? And finally, are you going to just let all that money continue to languish over there at the local bank earning next to nothing in interest while they keep making money on your money? Well, I say wake up and do something. Learn to be more shrewd with your money and ways to keep more of your cookies in your financial cookie jar by speaking with me in person, Tony Walker. For more than 37 years, in meeting with over 15,000 savers just like you, who are looking for someone they can trust with their money and their retirement, someone who will strive to work in their best interest, we at Tony Walker are doing just that. It's easy to visit with me, and best of all, it's free. We can talk in one of two ways, either by phone or in person. So to get started right now, just either call the toll-free number on your screen, yes, even if it's on a weekend, as we have a live answering service that'll take your call, and our offices will call you back on Monday morning. Or if you like, right now, just log on to TonyWalkerFinancial.com and simply click on that Let's Get Started. And oh, by the way, rest assured that when you go to our website, your information is kept in the strictest of confidence and never shared with outside vendors or anyone outside of Tony Walker Financial. So do it now. Log on to TonyWalkerFinancial.com. Well, we hope you've enjoyed today's program. We've certainly enjoyed bringing the information. But you remember, between now and next week, if all else fails, you be worry-free. Make it a good one.